Yeah.
Hey everyone, it's Andrew Berman from NMP, and you're watching another Mortgage Leadership Outlook, the series that started back actually in 2020, when things just started going crazy from coronavirus, and we just wanted to figure out, like, what do we do? We're pulling out our hair out of our ears, out of our heads, and basically we met with leaders, great leaders like the great Will Fisher, who's joining us today, to talk about actually, what we were going through at that point, and we just kind of continue to have this dialogue, to continue to meet with guys like Will, who is non-QM OG, was doing actually non-QM before most of us even knew what the heck non-QM is. Thank you for joining us, Will.
Thank you. Thanks for having me, Andrew. Great to see you today.
All right, so the first thing I want to do, listen, there's a couple of things I want to talk about. I want to talk about the future of non-QM, the big opportunities, the big obstacles. What do we see actually, from a political standpoint now with a new administration. But first, let's go back down memory lane, and go back actually to you're at Penn State. You're going actually to school for marketing, and you're dreaming of being a mortgage banker.
Hardly.
No one ever does that.
Nobody ever does. This business finds you, and this business definitely found me. That's for sure. But no, it's a great story. I actually graduated Penn State, went over to IBM. Great position in New York, working in data storage. Back then, and they were just figuring out what a cloud could be and all that kind of fun stuff. And anywho, 9/11 happened, this and that happened, the economy, the dot-coms busted, and wow, what an opportunity. So I came on out west, as a matter of fact, and moved out to Mammoth, of all places, and just got my start there. And from Mammoth, moved on down to Orange County, and with a good opportunity, and then got into the space at that point with a company called First Street Financial. And then from there, learned the business, went to Acra first, moved up from there, went into retail for a little bit. That was an interesting experience, and doing retail. And that's why I have the utmost respect for loan officers and what they go through, and the conversations they have on a daily basis to understand every borrower they have. So it was a good time. It was a very good time. But yeah.
Let's if you don't mind, I want to go back actually. So you're at two great companies actually back actually in the 2000s. Products were crazy. So tell us what was the craziest product that you saw out there? Like, just think about actually the one where you're like, they're gonna do what? Like, what was the craziest thing actually you saw that just kind of was like that moment that you're like, I think we might have a problem here?
I thought it was going to be one day out of foreclosure, one day out of bankruptcy, but I was wrong. It was actually the pick-a-pay. The pick-a-pay is when I was like, wait a second. So if you can't afford it, you can just pay this, but you're telling somebody it's that. And they're like, yeah, pretty much. And I had a friend that was over at Bear, and he was just like, dude, you got to come over. You got to check this out. We're crushing. We're going to crush it. I'm like, yeah, I think we're all done. And lo and behold, yeah, pretty much the world ended on that paper. But yeah, that was definitely the wildest thing I've ever seen.
Oh my goodness. So I don't know. It's amazing. People, and they think actually non-QM, like the old schoolers are like, nah, I stayed away from subprime when it was back out then, and I did good actually then, and I'm staying away from this newfangled subprime. Like, they don't understand actually that this has nothing to do with it. Like, this is so different actually of a product. So talk to us actually about and I'm coming from actually a webinar that I just had, and someone messaged me personally actually in the middle of the webinar, said, I'm telling you, Andrew, this is going to blow up one day and you're going to come back to me. But talk to us about actually why actually the fundamentals of non-QM is so much stronger, than, the let's call it the greed driven, because it was driven by greed by multiple parties, borrowers, everyone else, the greed driven subprime days. What are the huge differences from a fundamental standpoint?
Well, first off, the credit quality, the the borrowers that are available and have been available since 2013 for this space have all had a much higher credit quality. If you look at the pools of loans that have been sold and gone to securitization for non-QM, you're going to see an average credit score that's anywhere from 680 up to 720, or could be higher. But that's pretty much the makeup right there. And, as far as LTVs goes, there's so much more equity in the homes now than there was at that particular moment in time. And that's what we're seeing. And it's not that it's really ratcheting up at any great degree. Now, you will see some pools at 75, 76 LTV. And I've seen those, maybe even a touch higher. But for the most part, it's right in that sweet spot that we want to be at, that, anywhere from 69 to 72% LTV. And it's just credit quality and equity that's really different this time. On top of that, there's no need to really go that far down south. Yeah. I worked at a company that funded borrowers that were 500 or sub 500 credit scores, and there's a reason they're there. And guess what? That also translates to their mortgage payments sometime, no matter how much equity they have. So there's really no rush to get there. But the big thing is the borrower makeup. And the borrower makeup this time is very, very good. Probably because we had so many years of not being able to, or not funding this paper and sticking mostly with just agency lending from 2009, 10, really, all the way up till 2013. And then, non-QM didn't really even take off until probably 16, 17. Yeah. And it really started to get traction, obviously, in 18. But, it's definitely been a learning curve for a lot of folks. I mean, I remember walking into a broker shop in Florida with a rep that worked for me named Karen. And we made a broker's blood boil because he was like, I almost lost everything due to not New Century, not Resume, the other one. I forget their name.
Request Argent?
No, the other one.
American Brokers Conduit?
I'll remember in a moment. But he was like, I almost lost everything due to that company. And it was understandably so. But no, we had to explain to him how non-QM worked, how it was different from QM, safe harbor, rebuttable presumption, and where we fit and everything, and how we're doing this and what the docs are going to look like, the whole thing, just to get a comfort level there. And he also had to realize that he wasn't a correspondent. This was a wholesale loan. So quite frankly, the risk is mostly on us, the lender. Yeah. But once that was understood and talked to, it opened up. And we had to, really blaze that trail to build non-QM, which we were actually calling non-prime back in 13, 14, 15. Yep. And, because we knew nobody would even understand what the word non-QM meant. They're like, so I qualify for a non-qualified mortgage? How does that work? And so we try to keep it simple. And some other folks had some great names too. I mean, Impact had a great name, Alt QM. That was a great name. Probably that should be the industry moniker. But, non-QM is now here and it's understood, and we're in a much better place now.
I never thought about that. It's really actually a much better thing than non-QM. It's like, saying something you are something, no, you're nothing. Actually, it's so. All right, so what would you say actually is most originators' biggest obstacles? Let's say they get past the point of actually saying, okay, these are fundamentally good loans. I mean, and I think actually what it's been made example, and you look at the performance of the loans, through 2020, like those loans were still performing for most of the lenders that I've talked to. So, what is the obstacle in terms of actually embracing it and being able to offer it, to the borrowers that most originators face?
Well, I think a lot of originators are scared by the rate and sometimes the documentation. I think they don't know how to pitch it correctly. They don't know how to talk to the borrower to it. I mean, what I've seen is some folks say, hey, look, I'm going to tell them what they don't qualify for. I'm going to mention your product, and then I'm going to follow up with them 3 days from now, and I'm going to get them. Because they're going to hear no from so many other people, and then they're finally going to be ready to go with you. But that's the challenge. The challenge is for the loan officers really is the explanation to the borrower why. At a company I worked for, what we did with some of the retail folks is we would show them the rate sheet and just say, look at the rate sheets. And I'd go to my retail or broker shops and tell those brokers, hey, show them the wholesale rate sheet. Show them where they fit. It's not going to change. The rate's not going to change. We're not going to give somebody else something better. And there's nowhere else really for them to go. So just show them where they fit in the scale and why they fit there. And once they see that transparency, a lot of times they say, okay, sign me up. Let's get this loan done.
So Will, do me a favor. If you could let's do a little role play here. Let's say actually you are the broker that actually that sees actually the financially savvy business owner borrowers come to you, and you realize actually, because even though actually he's driving actually a Bentley, he's only showing $70,000 on his returns at the end of the year, because we all know the IRS doesn't penalize us for being bad business people at the end of the year. So let's say actually where this and you're trying to actually have this conversation with me to tell me actually that I am actually the prime candidate of this non-QM, alt QM, non-prime loan.
So that's an interesting scenario right there, and that's probably, I think, almost half the non-QM scenarios out there are that self-employed, business purpose type person. And that is going to be an alt-doc deal. That's going to be bank statements. It's going to be asset depletion or asset utilization or some type of no ratio program. That's where that's going to fit. And that's because that borrower, they're pretty savvy usually, and they can easily understand why they wouldn't fit into the mold of a Fannie agency type loan. However, you show them, if I show you bank statements, if I show a P&L, if I show all these assets, I can get you a loan and a rate close enough, down far enough that you're going to have a very good payment. You're going to get the cash out or any proceeds you need, or you're going to get into that house. And, guess what? Over time, over the next year or two, if you want to pay the full pop on taxes and you really want to get to that agency loan, you can still do that. But this will actually will get you into the market, get you into that house, get that cash out. And it's just a different method of approaching it with them, because look, and there's also knowing when to do it probably and knowing not when to do it. If you're leading with that and they don't understand why they don't qualify the regular way, you're going to have more of an uphill battle unless you explain this to them, why they're not qualifying here and there. And then you show them the other options. But the bank statement loans come so far. I mean, it was 24 months, no messing around, back in 13, 14, 15. Right. And then it went to 12. And then it went to 3. And then I've seen 2. And then there was 1. And, and now it's back to 3. And then some folks are doing a P&L and this and that. And so it's, you got to look at the performance. The performance is there.
There's also borrower stated P&L now.
Yes.
It's not even just like a CPA, like, you as the borrower state your profit and loss. I don't know. It sounds like
it's funny you asked that. We actually, at Mega, we've just brought out our new product mix. And part of our product mix is a business P&L. And with this business P&L, it's got to match up just like a CPA prepared P&L would.
Yeah.
But if it does, your borrower is going to qualify. And they're going to qualify at some different expense ratios that are more appropriate for their business and what they can prove their expenses are. And so, that's one of the neat things that we're doing at Mega. I mean, we're not coming out with 31 flavors of loan product.
Well, just before we get off of that, I want to know actually, because listen, and we rarely talk about product on here. Like if we talk about the person, we talk about the individual, but I gotta say, like I'm excited about it. I'm excited about like what you're doing over there. You've been actually in charge of the growing non-QM, and you've been part of actually companies that have really been innovative when it comes to products. So like when we agreed to do this, I'm like, well, I'm going to talk about product. We're going to have some conversations about product. So tell me actually, tell me a little bit more about that. So it's a P&L, a business owner P&L, and they're putting it in. So What is it like? What kind of LTVs actually will you lend out on that?
So, like was going down the road of here, we're not going crazy with LTVs. We're not going crazy with credit scores. We're pretty middle of the road. We feel that there's a really good swath that we can capture between 80% LTV down to a 660 FICO. We think we're in a really good spot right there for our initial rollout. And then we're going to start expanding things out as we see we need and as we build our team up in the back end here. So it's pretty much well designed in a way to build accordingly. So the right product is there. Now, that's not the only product. There's other aspects or ways you can qualify with bank statements. We don't, make just one. While we have one, I'd say, signature product in that space, we have a couple other ways to qualify that I think are more innovative than some of the other folks out there with just a solid expense ratio. So we do that. Then, our asset utilization is a supplement for our other income types. And then what we're really excited about is our investor product. And, we have this product now. We have a one-to-one DSCR, and a lot of folks have the DSCR down to 0.75 or the 1.25. However, our mega DSCR product, I'm super amped about, and that's a no ratio DSCR. Wow. And so what that's going to allow the borrower to do is qualify very simply. We're underwriting the appraisal, we're underwriting the other aspects of the file. And, there's a couple little ins and outs we'll discuss specifically with the broker that they'll need to provide to get the qualification done, get the loan through. But we see that loan closing in like a week, 2 weeks. I mean, a very, very fast process for that loan. So we're just engineering this whole operation for speed. We're engineering it so that it's just a very efficient process for the broker. Our online engine for dropping the loan in, you're really dropping all the pieces in one shot. You're getting an answer. You're having very few conditions, and you're right back out the door on the other end. And so that's how we're, design the process and the product.
Awesome. I mean, and listen, to understand actually the mechanics behind it, I think is important. But I got distracted by this. You're not lending in New York. So few lenders lend in New York with non-QM. It's an unfortunate thing. I know we were talking about that before, actually, when at a previous company we're at, and it's unfortunate. But Mr. Berman.
Yeah, so right now we're in 13 states right now, but they're the biggest states, by design, and we're going to be expanding accordingly. So, we have a few on our radar, like North and South Carolina, some more on the East Coast, and a couple others in the Midwest, including Utah. So right now it's mostly California, Texas, Florida, Washington, Oregon, Arizona, New Jersey, Virginia. This is where in Washington, D.C., this is where we want to play at the moment, where we're building out. We're looking for account executives. We're looking for ops. We have tons of territory open. And we just plan on getting more and more innovative, more and more, aggressive as far as rate goes as we move on. So as far as states, if you're in New York and you're looking to do New York, there's a couple really good companies that do New York. I would definitely check out ARC possibly, or a couple others that cover New York, and they'll treat you just fine.
Yeah, basically go to actually to Will's LinkedIn profile, and you've got actually context right there. So actually, Mr. Berman brought this up. I love this. This is great. Is still room for creating new non-QM products? So basically, what is the future? Like, are we actually at the point where this is all the non-QM products that we'll have? Having actually the near miss stuff, the bank statements, the DSCR. But do you see actually other potential product innovation that will come to market?
Absolutely. I think there's a lot of trial and error that's already been done and tested in the secondary market and tested with rating agencies. Some of it's worked, some of it hasn't, some of it's still going through its trials. I think we're going to see a return to things like 1 month style bank statements and 3 month and whatnot. I think I don't see how much more aggressive or innovative you could get on the DSCR. I'd be a little fearful of going up much higher on LTVs with any type of product that doesn't require any type of ratio. But there is always going to be room for trial and error in this. So yes, there will be more innovation, and it'll be fun to see who brings forward that innovation. And I think there's going to become more innovation in the underwriting of the loans as far as service levels and automation. I think that's the next level for non-QM. I don't know if there will ever be a full TU style underwrite, but I think there are some folks out there working on AI and things to apply to non-QM that are going to make the process easier, or almost self-qualification in some cases right online.
Oh, wow. With non-QM, that is amazing. That's powerful. I mean, so do you think actually any idea, what it's taking actually, to go from application, to closing table with non-QM loans?
Well, remember, we always have to abide by, if it's owner occupied by trade. So we're always going to have, a certain amount of closing and setting up for that. But I think for your business purpose style loans, and then eventually once this market comes back, like a small balance commercial style space, I think you're going to see more speed in those type of transactions. I can tell you right now that hard money space, where people like Lima One and Velocity and a few others really play in, they can close in minutes. I mean, there's AVMs and ways of looking at appraisals. I think there's room for speed to be added there, depending on how comfortable we're going to be with AVMs in the owner-occupied market, getting away possibly from appraisals, and depending more on that automation. It seems to be working pretty well for some of those other lenders in that commercial space, and maybe that can start to apply to residential as well. But other than that, I think there's just a little bit more tweaking that can be done. Otherwise, you just got to be careful. We don't want to get back to 100% LTV one day out of bankruptcy, foreclosure, short sale.
Something, I feel like that borrower would be like, okay, this is my second chance. I'm not going to screw up this time. I think I feel like that's better than.
Well, that was 100% LTV.
Okay, maybe not. Oh my goodness. All right, so we got another question that just popped up here. What sort of volumes are you seeing originated both internally and elsewhere in the market? How do these volumes vary across products? From Henry Brokesmith.
So you're definitely, obviously you see A paper has just exploded over these last couple months with COVID. Rates have dropped, and I mean, all-time highs in funding levels. I know folks who are just having banner years. Now, as far as non-QM, it's picking back up. It's not quite where it was at the end of 2018 and the beginning of 2019, but I have heard folks are now not so much 100 million, but at least in the high, 60 to 80 million a month category. I can't tell you what Angel Oak's doing, don't know, but I would assume that they're probably up there, and leading that way. And, hopefully we'll be able to capture them or catch up to them one of these days here. And I think we have a great team and a great product to do it. But the growth is going to be moving towards the non-QM as you start to see the rates in the agency conventional paper start to rise. We used to say back then, get prepared for it, get ready. You better know how to do non-QM, because once the agency dries up, you're going to be in trouble. Well, now you're going to need to know, because if you ever thought you were going to have a hangover before, well, you've very much gotten drunk on these rates for the last couple months. And when that dries up and you have nothing else to hit, non-QM is going to save you. Non-QM is going to be there to help you get those high dollar loans done, help you get those self-employed borrowers done, those purchases done. It's going to be a very interesting time in the space.
Yeah, without a question. So, all right, listen, I'm going to ask you this, because listen, you The two previous companies you worked at, you were basically there to build out non-QM. The great companies that rolled out non-QM, and just like especially Arc did it in like a 0 to 60 in like in a very short time. And Citadel was there actually from the beginning, like before anyone was talking about non-QM. So talk to us actually. What were you excited about the opportunity with Mega? Like where did you see like, oh my goodness, this is where I'm going to actually to hang my hat actually and help these guys take this to that next level?
So that's a great question. And with Mega, there was a chance to put my fingerprints on a lot of things. And Brian Nog, amazing CEO, great guy. And he has a vision. He has a really clear vision. And it's nice to see that, from the CEO leading the company where they want to be. And, non-QM is just a small part of what Mega is and what Mega is going to be. So I just saw a really good opportunity to play a good role as a supporting character and help get non-QM off the ground and moving in the right direction. The one thing that we have here is we have a proprietary product. It's our product. We're putting our loans together, getting them set up for bid and putting them out to the street, to the market to be bid on. This is us. This is Mega's loan. And we're proud of that. And it's just really great to be part of that and to help build that with this team.
Got a comment from Joanne. We need the warehouse lenders to open up. Are their securitization levels climbing?
I think every day the warehouse lenders are seeing that they need to keep opening up. We're having dialogues with warehouse lenders ourselves about expanding, our capacity and other capacities for some of the folks in the space as well. And you can see every day that the 10-year kind of ticks up a little and their volumes dry up a little on the agency stuff. They get more and more interested in non-QM. So that's my take on it. I think everyone's going to start to see that. You just need to reach out to more of the warehouse lenders and get those relationships going. It's extremely important.
Cool. All right. So listen, I'm going to ask you one last thing. So save the toughest for last. All right. As this country just got painted blue, what is the impact going to be on non-QM? I mean, just obviously, just your opinion of like, let's pretend actually we're at a trade show, actually at a cocktail hour, and you're just sharing actually what you feel is going to be actually the future of non-QM under the new administration.
Great question. I think we're already seeing what non-QM is going to look like to some degree. We're going to get a glimpse. We're hearing about it on either from the Chrisman report or the IMF daily about new changes in ranks at the CFPB and what they think of the QM patch and what was done and what was rolled out. And quite frankly, I think it's going to move back towards a Richard Cordray style CFPB, if not maybe a little tighter. And it's going to be very interesting for the bigger banks and whatnot to see how this plays. I think for the non-QM hardcore out there, and the folks that are dedicated to the space, I don't see an issue. I think they're just going to roll with it and keep doing what they do and get bigger and better at what they do. And then, and that's how it's going to roll. I think the rules that played out here or rolled out before the end of the previous administration were interesting to say the least. I mean, basing things on an interest rate, on how, you're really going to qualify them as far as the DTI goes and their ability to repay. For some folks, that was a bridge too far. For some folks, it's going to be an epic payday and volumes should have been, insane. But you really don't know until it gets laid down and actually rolls into law. So with this administration, I think we're going to see what non-QM was starting to shape up as prior to 2016. And it's going to be a pretty fun next couple years, I think, in non-QM. And, come on in, the water's just right. There's nothing subprime-esque about this. It's all very makes sense.
Yeah. All right, awesome. Well, always great to spend time with you. Really, really appreciate it.
Awesome. Thank you, Andrew. Thanks for having me.
All right. Thank you so much for watching us. Thank you for joining us for another Mortgage Leadership Outlook. We come to you every Wednesday, 1 o'clock Pacific, 4 o'clock East Coast time. We will see you next Wednesday. Have a great week.